Welcome to the What Matters Today podcast from the Geneva Graduate Institute. I'm Dan Graham, Head of Communications at the Institute. In this podcast series, we ask members of our faculty to comment on key global issues. In this episode of What Matters Today, we examine the evolving landscape of global economics under the new Trump administration. We'll explore the potential shifts in inflation trends, fiscal policies, and trade relations that could shape both the domestic and international economic environment. We'll discuss how these changes might influence global trade dynamics and economic partnerships, particularly focusing on regions closely tied to the U.S. economy. Additionally, we'll take a historical perspective to compare this moment with previous periods of political and economic uncertainty, seeking lessons that might illuminate the path ahead. Our guest today is Rui Esteves, Professor of International History and Politics here at the Geneva Graduate Institute. So Rui, thank you very much for joining us on this episode of What Matters Today. I'm just going to go into the first question. So how do you expect inflation trends in the United States to evolve under this new Trump administration? Could we see policies that either curb or intensify inflation? And what might be the global ripple effects of those trends?
Thanks. Well, inflation trends under the Trump's future administration will likely be influenced by a combination of trade policies and domestic fiscal measures. Now, the announced aggressive tariffs he has proposed would raise prices on imported goods,
right?
Particularly consumer electronics, vehicles, and other goods that are especially dependent on global supply chains. This could then intensify inflationary pressures, particularly if businesses pass these higher costs on to their consumers. At the same time, the also pre-announced domestic tax cuts and spending increases would then fuel demand-driven inflation in the US, particularly in sectors like construction and energy. Now, globally, these dynamics would then lead to tighter monetary policy by the Federal Reserve to fight inflation, which then will strengthen the dollar. This would have ripple effects, particularly in emergent markets, which often face increasing borrowing costs at capital flight in periods when the dollar appreciates. Now, this was, for instance, the case in the 1980s, when the combination of a very restrictive US monetary policy and large fiscal deficits under the Reagan administration led to an US dollar appreciation of north of 70% between 1980 and September 1985, when a group of nations met at the Plaza Hotel in New York City to discuss about ways of how to actually weaken the dollar, because it had gone too far even for the US. Yes.
Wow.
Finally, in domestic terms, what does this mean? Well, probably for middle and lower income households, this probably means that they'll feel squeezed in case this price growth outpaces wage gains, which might then exacerbate existing trends in inequality.
Thanks for that. And what fiscal policies do you anticipate the Trump administration will prioritize? Could we see significant changes in tax policy, government spending, or infrastructure investment? And how might these impact both the domestic and global economies?
Well, in point of fact, we know very little about the future tax policy of the new administration. But from what has been announced or tweeted, I think it's fair to expect, ongoing tax cuts, particularly for corporations and high-income individuals, with some possible selective tax relief to the middle-class households. In terms of infrastructure spending, this could also be a key focus of the new administration, with investments mostly aimed at securing energy independence, manufacturing reshoring, and also transportation. This will all likely be financed through increased deficits, which reflect at least the avowed future administration's prioritization of growth over fiscal discipline. Now, at the same time, although this is all very speculative, Trump has also announced the appointment of Elon Musk and Vivek Ramaswamy to lead a future Department of Government Efficiency, right?
Yep.
Tasked with the incredible task of cutting the federal government spending by $2 trillion a year and extinguishing or restructuring large swathes of the federal government. While these objectives are all but unrealistic, they do signal an intention of paring down the size of the government, which might partly compensate for the other inflationary tensions driven from reduced taxes and increased investment spending. Again, domestically, what would this mean? Well, these policies could stimulate short-term growth, for sure, but they will raise concerns about long-term debt sustainability. Now, prior to the election, the Congressional Budget Office, which is this independent budget watchdog in the US, predicted that even if the tax cuts introduced by Trump in his first administration were allowed to elapse next year, which is very unlikely now, the size of the US federal debt would continue to increase from about 125% of GDP, which is where it is now, to 175 by 2050.
Oh.
And the problem with these projections is they're mostly driven by things that we cannot change, not even Trump, which are essentially adverse demographic trends in terms of expected increase in healthcare costs and pensions. Now, on the global stage, these larger predicted US deficits could then push up world interest rates, which would create challenges for countries with high levels of external debt. Additionally, protectionist tariffs, again initiated by the US, would dampen global trade volumes, limiting growth in export-dependent economies. And frequently, they're the same type of countries. While tax cuts and infrastructure spending may boost US economic activity again in the short run, these longer-term risks of fiscal imbalances could reverberate throughout global markets, creating volatility and again reducing investment flows.
Let's talk about China, because trade relations with China were a key focus during Trump's first presidency. Do you think this approach will continue? And if so, how might it affect global trade dynamics, supply chains, and economic partnerships?
For all we know, until now, Trump is likely to maintain or even enhance the hardline stance on China, emphasizing tariffs, but also restrictions on Chinese technology and efforts to reshore critical industries. Now, these policies could then exacerbate already existing trade tensions, disrupt global supply chains, and compel firms to diversify their sourcing strategies towards other Asian nations or even closer to the US in North America. So this so-called decoupling from China could accelerate regional trade alignment, such as the US strengthening ties with India or Mexico. So it's not only pure geography.
Right. Yeah.
Beyond China, the ripple effects of US trade policies may disrupt global trade networks and partnerships. Emerging markets, which are reliant on the US for their exports or indirectly tied to these US-China trade tensions, namely because they're part of global supply chains that connect the US to China, could then face slower growth. Financial markets may also react negatively to trade tensions, amplifying volatility, creating challenges for economies which are more dependent on stable, ongoing capital flows. While some economies could benefit from supply chain diversification or commodity exporters from the renewed effort of the US in infrastructural investment, the overall impact is likely to be a drag on global trade and investment.
Right. Thank you for that. And how do you think Trump's re-election will influence international markets, especially in regions that are closely tied to the US economy, such as Europe and emerging markets? Are there specific sectors you think will feel the impact most acutely?
Since I've spoken quite a bit about trade up to now, I'll focus now on financial markets. Trump's re-election is likely to increase volatility in financial markets, driven by his aggressive trade policies, but also fiscal expansion and the inflationary pressures stemming from these higher tariffs. One key area of focus will be the foreign exchange market, which will be the first one to take a hit, particularly the US dollar renminbi exchange rate. Now, back in 2018, during the first Trump administration, when the US imposed a 25% tariff on half of its good imports from China, the renminbi depreciated by 10% against the dollar, which effectively offset all of the tariff's impact. This meant that the dollar-denominated prices of imports, Chinese imports into the US, remained essentially the same. This episode demonstrates that markets treat tariffs as a negative terms of trade shock, prompting a currency depreciation in the country that faces the tariffs to counterbalance the loss of competitiveness. Now, if the US introduces significantly higher tariffs, as Trump has been threatening, the renminbi is likely to face even stronger depreciation pressure. This is not only because the Chinese authorities will try to compensate for the tariffs by intervening in the foreign exchange market, but also because China has a recent history of capital flight during periods of depreciation expectations. Essentially, Chinese families, if they expect that the renminbi will take a hit try to export their money, put their money abroad ahead of that happening. Now, this most recently happened in 2015 and 16, when China lost fully $1 trillion in reserves and underscores these risks. Now, while China has tightened capital controls since this episode, precisely to prevent it, I guess the key takeaway is still a need for these authorities for a swift and substantial depreciation to prevent households from acting on their expectations. Now, for instance, if the US were to implement the announced 60% tariff across the board on all Chinese imports, as floated by the president-elect during the campaign, the renminbi might need to fall by as much as 50% against the dollar to maintain stable US import prices. Even if China retaliates with its own tariffs, which would reduce the scale for this potential renminbi adjustment, it would have no precedent in recent history. Well, then, such a depreciation of the renminbi would have profound effects not only in China, but on all other manner of emergent markets. Starting with East Asian countries, their currencies would likely decline alongside the renminbi, which would then create a ripple effect that would weaken the currencies of all emergent markets globally. Commodity prices, they would also fall for two main reasons. The first one is that tariff wars are never actually a great piece of news in terms of global economic growth. Second, because global trade is predominantly invoiced in dollars, which means that a stronger dollar would reduce the purchasing power of all emergent markets, which would then further strain their already under-strained economies because of higher interest rates and inflationary pressures. The stock and bond markets of these nations would also then experience heightened volatility, as investors, both domestic and foreign, would react with a lower global risk appetite. And also because if their currencies would devaluate, in the case of foreign investors, any expected returns that they had cashed in would be wiped out by the depreciation of these currencies relative to the dollar. About Europe, well, the euro may face indirect pressure from these dynamics, especially if economic uncertainty drives safe haven flows back to the dominant currency, which is still the dollar. Sectorally, industries like technology, manufacturing could be hit hardest by continuing US-China trade tensions, while commodity exporters might benefit from higher infrastructure spending in the US. In Europe, uncertainty around potential US tariffs on automotive and other imports could weigh on economic growth. Defense and energy sectors may again see some gains given Trump's avowed emphasis on these areas, but the broader outlook for international markets still will likely remain highly uncertain.
It's going to be very interesting to see how this all plays out. And for my final question, from a historical perspective, how does this moment compare to previous periods of political and economic uncertainty in the United States? Are there lessons from history that can help us understand what might lie ahead for the US and its global economic role?
Yeah, so Trump's renewed focus on protectionism, aggressive fiscal expansion, and economic nationalism recalls, of course, the slide towards autarky and trade barriers of the 1930s, particularly after the Smoot-Hawley tariff of 1931. Just as tariffs in that era aimed at protecting domestic industries, Trump's policies aim to prioritize American jobs and production. Trump's re-election, on the other hand, also marks a period of economic uncertainty, which is reminiscent, again, of the early 1980s under Reagan, characterized by aggressive fiscal policy, high deficits, and geopolitical tensions. However, history demonstrates that even if such measures could spur economic growth in the US in the short term, they often backfire, leading to trade wars, reduced global growth, and financial instability. For emergent markets, in particular, the best option to navigate this heightened period of uncertainty will be to drop any attempt at pegging against the dollar and instead use their exchange rates to absorb what is likely to be a very large shock initiated by the US and made worse by the retaliatory policies of other large economic blocs such as China and the EU. Large depreciations can boost inflation in these nations through imports, but central banks in emergent markets have become better at tackling this. Indeed, they navigated better the inflationary shock of COVID than the central banks of richer nations. These shocks are then likely to erode further the economic role of the US, and in particular of the US dollar. Since the post-war, the US has enjoyed an exorbitant privilege in that the US treasuries are the world's safe asset, which then is accumulated by foreign central banks and corporate portfolios. This allows the US Treasury to fund its debt at favorable rates, which are anchored by foreign demand. A fall from grace of the US dollar would cancel this privilege, at least partially. Now, to date, there's been no significant exodus from the dollar and towards other currencies, even despite the ripple effects of the weaponization of the access to the US money market by the sanctions introduced against Russia after the Ukraine invasion. However, it's conceivable that foreigners might be less willing to hold US debt going forward for fear of a lack of resolve on the part of the US government to control the US debt dynamics I alluded to previously to revenue cuts and or tax rises. Foreigners may also fear that the US may inflate away its debt in real terms, particularly if President-elect Trump follows through with his menace to curb the Federal Reserve's independence. So a possible future scenario is one of a multipolar world, no longer multilateral, but multipolar, where trade, credit, and monetary arrangements are organized regionally or along political allegiances, what's been called friendshoring, in two or more economic blocs centered around the US, China, and possibly the European Union.
Thank you very much for that. And Rui, thank you very much for joining us on this episode of What Matters Today.
Thank you.
This podcast series is produced by the Geneva Graduate Institute communications team. For more information about the Institute, please visit our website at graduateinstitute.ch. I'm Dan Graham. Thanks for listening.